All right, everybody. We have an amazing guest today on the podcast, Mr. Rob Brown. And how long have we known each other?
I guess we've known each other since at least 2009, 10, 11.
Yeah, was it right after the financial crisis? I think we were both we came from the MSRE program in San Diego, which is a master's program in real estate development.
Exactly.
And I thought it was pretty funny. I think we were corresponding on Instagram the other day. It's like, because you'd close some big deal with a client. And I was like, oh my gosh, that's amazing. And you're like, well, we have to make our degree worth something.
Yeah, right. If we're not closing big deals, it's kind of embarrassing. We went to grad school for this.
Right. I mean, because I think it's one of, 3 programs maybe in the country that's specific to real estate development?
Very few.
Because I know San Diego State has one, if I'm not mistaken. Mm-hmm. USD, which is University of San Diego, which is where we went, has their master's in real estate development, the MSRE program. What did you think about that program?
I think the program was really good to teach somebody the basics and the more complex elements of financial modeling, the real estate development cycle, and investment basics that doesn't come from a real estate background. What's important for somebody like me or like you that already had a real estate background, maybe second generation real estate entrepreneur, is the local network here in San Diego, which I did not have because I was born and raised in Las Vegas. So the program's super linked in with all the top residential, commercial developers, investors in town, and it gives you those relationships.
What do you think about, I 100% agree with that. I mean, that was probably the biggest thing that I took away from it. And what was cool is they would bring in adjunct developers, right? As professors, right? So I'm sure we had, real estate people and real estate developers aren't the most cordial individuals.
Exactly.
Right? I mean, they're running at 100 miles an hour, high D personalities, typically if they're very successful. So them coming in and trying to be professor for the day, it doesn't really float that well, which was great that the real professors left the room.
Exactly.
And then it would leave the developer there to just teach. Because I remember one of the guys came in, I forget his name. He had done I don't know if it was Las Olas down in South Bay or whatever it was. But he comes in and the professor's leaving. He's like, listen, okay, they're teaching you the book shit. We're going to close that for a minute. We're going to teach you the street smarts way of development. And this is how we do it.
Exactly.
And that was hands down the best part about it because you got the book side of it, which you need. Mm-hmm. But then close that book and let's bring in the real people executing. And how does it really get done?
Absolutely. I think that's one of the best parts of it was having local developers. Some of the professors like Sherm Harmer, were deeply involved in residential development in San Diego, 70s, 80s, and worked for the Irvine Company. So had that institutional quality development experience, telling you how it really works, where the political intersects with the development cycle. Which is legit. I mean, it's very much connected.
Yeah, especially in California. It's like, hey, who are we going to talk to today? Are you going to goose or, not to say that gets done, but,
Oh, yeah. I mean, I learned that earlier than most when I took over family business and was shocked by it originally because I'm like, wait, this can't possibly be the way things work. And then once you're exposed to it, you realize that's exactly how everything works. Yeah,
which is wild. Las Vegas. You grew up in Vegas, originally from Vegas?
Yeah, I was born and raised in Vegas.
What part?
Well, when I was growing up, Summerlin didn't exist. That's where we moved when it was developed. But growing up, we were living off Decatur and Oakey, which is over by Rancho Bel Air neighborhood. Okay. And that was where my dad's store was, a fantastic furniture store. So he worked there 8 a.m. to 10 p.m. a lot of nights, ran the whole thing 7 days a week. So he lived 10 minutes from work.
Wow. Yeah, I remember my dad was... after the RTC crisis, which was the savings and loan crisis back in the mid 90s. And after that, he had started leaving California for development, ended up going into Boise, Idaho for a little bit, and then dropped into Vegas. Yep. And I want to say that was 96, 97-ish, 98, 99, 2000, maybe 2002. Did a lot of apartment, I think 4 or 5 large apartment deals there that were 200 to 400 unit deals. Mm-hmm. So they were big. I think Giovanna Villas was one of them. Los Cabos 1 and 2 was another one. He had Sahara West, which was by South Point Hotel. It's down there now. But yeah, looking at the old Vegas aerials.
Oh yeah.
And seeing where it's at today. What do you foresee for Vegas given the baseball team? Obviously, basketball's likely coming in there. You have football, you got hockey. mean, you know that area. So
Vegas has been explosively growing. It was the fastest growing large city in America from the early 1980s until the 2008 recession. And now it's on another boom cycle. My parents moved to Las Vegas in the 1960s. It was a small town with like 80,000 people who lived there. So if you owned any business in town that was even moderately large, they all knew each other super well. And they knew all the political leaders and the casino owners super well. And it grew into a major big city during the 80s and 90s.
is that when the Mafia came in?
No. I would say the Mafia was on its way out in the late 70s to early 80s and completely out once Steve Wynn got Michael Milken with the junk bonds to corporatize the finance of the casinos. The reason why the mob got involved was because you couldn't borrow money to build a casino. It was a vice business. So it was a little bit of Mormon banking with like Perry Thomas, which later became, what do they call it in Utah? Zions Bancorp merged with his old company.
Wow.
But they wouldn't do business. Perry got him to do some business with Steve Wynn. He was the backer of Steve Wynn. And then later he brought in Michael Milken with junk bonds, and he didn't need the Teamsters pension fund money anymore.
That's wild. So that makes sense. So that's like they basically, commercialized it in the sense that you can actually get traditional financing in those junk bonds, more traditional style financing versus mafioso money.
And as soon as that happened, like whatever happened with Milken happened. But after that, when people saw there's the exact same market for those bonds, the same risk adjusted return to the investors, suddenly the casino stocks really blew up. They used to trade at like a much lower multiple to a hotel company, but they actually have much lower risk because the part of their revenue that comes from gaming is mathematically predictable and less
mathematically predictable.
Totally.
Because it's rigged, right?
100% rigged. Yeah, it's an odds game.
I always joke. They're like, yeah, you're going to go gamble tonight? I said, listen, I don't look at it in the terms of I'm expecting to win money. I go there for the entertainment value. And I always say, okay, I'm going to dedicate $500 or $1,000 or whatever the number is to entertainment for gambling. And if I lose it, I lose it. But I'm there for the free drinks that come along with the gambling side.
Although you don't get as many of the free drinks anymore.
I know.
Big high roller.
I've noticed that. Because I was there the other time and I'm like waiting for the lady to come around. And I'm like, yo, where are they at? But they, I think, specifically set it up to where one every half hour.
Yeah, if you're lucky, you got to be at a decent table. When I was like 21 and let's be honest, maybe a little before, you used to be able to bring like $40 over there and play $2 blackjack and drink for free all night, and you lose like $10. And now, it costs like $500 to get, $20, $30 for the free drinks.
Pretty
you
much.
Would otherwise pay $100 for.
Yeah.
At $20 a drink, like the Wynn charges.
I know. So yeah, everything's so corporate now. Which main is it? MGM and then Caesar or Harrah's? Caesars?
The major casino companies today in Las Vegas are Caesars Entertainment, which is constantly going through a bankruptcy since private equity bought it out. And now
I didn't know that.
Private owner from Reno bought it out. They're still having some financial struggles.
So why?
Well, they put too much debt on the company, to get private equity fees.
Gotcha. So the private equity companies came in, they obviously blow it up, but because of all the fees and stuff they stack on top, the private equity makes all their money, but now you're left with all this stuff.
That was Caesars Harrah's. That's that company. Harrah's and Caesars changed their name to Caesars after the Harrah's bankruptcy and the recession. And on the other side of the aisle, you have MGM, and MGM is the one that bought Steve Wynn's old company, which was called Mirage Resorts, merged them together into MGM Mirage. Now they just call that MGM Resorts International.
And do they own the Wynn too and Encore?
No.
And all that?
The Wynn was what he did with the money he got out of the forced buyout when Krikorian basically made him the offer he couldn't refuse.
Yep.
He took that money, bought the Desert Inn Hotel, raised it, built the Wynn, and got the agreement in Macau.
Wow. And then what about Encore? And then, but he's
Encore's
out now.
Phase 2.
Steve's out, right?
Steve was pushed out. He got Me Too'd.
He got Me Too. So, but who did he sell to?
That's probably interesting to you, but more interesting to me is all of his old executives were pushed out with him because he got Me Too'd by his ex-wife, and now I don't get comps anymore. So that's what's really important to me.
I didn't know that this is where the podcast was going today, but this is like this is like the Las Vegas show, which is great. So, because I think it's fascinating because you see all the shows on A&E or wherever it is, they talk about the history of Las Vegas and how it grew. And I think I was watching the Smithsonian Channel the other day, and they just showcased Las Vegas and the story behind it and all its different kind of I guess, sectors of time, right? Because you had the Mafia time, which
You
is...
got to read the green felt jungle. That tells all the real stuff.
What's it,
there.
green felt
The
jungle?
Green felt jungle. Like
Why
the
is it named that?
Because of the green felt on a roulette or blackjack table. That's what they make the table games out of. The green felt.
Jungle.
Because jungle is kill or be killed.
So tell me some more history about Vegas. I'm like fascinated by this.
I'll give you some personal history. I don't know everybody else's stories,
so
but like my dad.
Let's go back to the Wynn thing before we finish up. So he gets Me Too'd out. All his executives get Me Too'd out. And who does he get bought out by?
Well, he didn't. He did a forced buyout. You know, when you lose your CEO position at a public company or go into public service.
Was he public? Yeah.
Wynn's a public company, has been since about 2 years after it was formed.
Okay.
And when there's that forced change of control, there's like a U.S. tax code thing. A lot of politicians make use of it when they go into the presidential administration, that you don't have to pay capital gains tax when you're forced to sell. So he sold his stock when the Me Too thing happened at the 5-year, 10-year peak of Wynn stock, cashed out with $4 or $5 billion tax free, and moved to Palm Beach by Donald Trump.
Wow. But who owns those hotels now?
The public company.
Oh, so Wynn still owns it.
Wynn Resorts.
But now there's a new CEO in place and all that stuff.
The biggest private owner now is his ex-wife, Elaine, that orchestrated that whole thing because he wouldn't let her sell all her shares to donate the money to charity.
Wow. So his ex-wife got pissed because of personal matters and then, took it out on him in a way and made him sell all his stuff.
Yeah, that's a lot of what the press covered and some other stuff I've heard from people.
Holy crap. Yeah, I didn't know the whole deal of it, but that makes sense now. So, no, but he's living his life down in Palm Beach. Health-wise, has he gone dementia or no?
No, he can't see.
Oh, she has cataracts.
He has ocular degeneration.
Okay.
So like when Steve spoke at my high school graduation, because his nieces and family went to my private school, they formed it for the casino executives' kids. And he spoke at my high school graduation. His CEO's daughter and COO's son were in my class. And so he spoke at our graduation. And at that point, he could see you, but he had an aide to help make sure that he knows who it is from far away. Gotcha. Once up close, he could see you clearly. Gotcha. I saw him in 2014 at NetJets event at the Wynn, and he couldn't recognize my friend's dad that he's good friends with until his wife's like, "It's Jerry Turk." Right?
Oh, wow.
Like, "Hey, Jerry, how are you?" And,
how old is he
brilliant.
now?
I think he might be like in his late 70s. He's a
genius. Similar to my dad's age, Jenna.
Mm-hmm.
He's 77. Yeah.
If you ever hear him speak, he can go on and on about anything. At our high school graduation in 97, the topic was, what should they know that they might not know they need to learn? He said, you should all learn to speak Mandarin Chinese and do a semester in China. This was in 97.
Yeah.
Right when the book The World Was Flat hadn't even come out yet, maybe in 98. He knew that. He's like, you want to learn how to speak Chinese, you go work on Wall Street, you'll be a billionaire.
Wow.
And then he spoke Mandarin to us at the graduation because he had studied it in the 90s. He's fluent in Mandarin Chinese.
Really?
And then he starts linking that through to the Italian Renaissance and art. And we're just like, wow, this guy's brilliant.
Wow. I mean, I didn't know all that stuff about him.
Mm-hmm.
Yeah, so tell me some other kind of en route Las Vegas stuff, because it's it's a fascinating town.
Vegas has expanded, like I said, tremendously. So anybody that owned real estate in Vegas back in the 60s, 70s, 80s, if you held onto it, very wealthy. My dad used to have retail businesses in the casinos, owned a little piece of the Desert Inn until they said, you don't own it anymore, we'll kill you. And so he's like, all right, that's okay. And the combination of that.
This goes back to the kill or be killed?
Yeah, that was the 60s. He invested.
You don't own it anymore or we'll kill you?
Yeah, they bought him out, I guess, because he knew somebody that would at least get him part of his money back that should have doubled or tripled. And then he had the businesses, but every once in a while the bosses' wives would come in and say, give us a fur coat. And you had to just give it to him, or we're going to use your phone for these illicit calls. So he's like, I need to get out of here. And so in the late 70s, he opened a retail furniture business and then got a bigger location by buying a warehouse out in the middle of nowhere. Yeah. And that's now the center of town. But that middle of nowhere in 79, he bought like a 20-acre property with a 250,000 square foot building from the New Frontier owners. And they were in a bankruptcy and strike after the guy died. $100,000 down, they sold it to him for $1 million in 79. And that was how he got into real estate, investing in a bigger way. Before that, he did small real estate investments.
Okay. It's fascinating. So now Summerlin's big, right? It's grown a lot.
Yeah,
where are the other hot, big, expensive luxury areas in Vegas?
So the biggest luxury areas in Vegas are the two master plan communities that both had the same essential developer. It's Green Valley on the east side of town that came first. And that was the
Green Valley. So if I'm looking at a map of Vegas, okay, so you got east side over here. Is it back by Henderson?
Yes. Yeah.
Okay.
Green Valley is a master plan community in Henderson.
Okay.
And parts of it go into unincorporated Clark County and Paradise close to the Strip.
Okay.
And, that was Green Valley was built by the Greenspun family that owned the Las Vegas Sun newspaper.
Okay.
And their son-in-law, Mark Fine, was the head of the development company there. He had real estate experience. Later, the Howard Hughes Company hired him to be their CEO. They're like, you did Green Valley, you do Summerlin for us. So then he did Summerlin, and that's why they're very similar.
Interesting. So those are the two luxury areas in Vegas.
Yeah, I would say those are the most high-end luxury out there is like the Discovery Land Company's Summit in Summerlin, or like the Ridges or Red Rock Country Club.
Because those are up on the hillside.
Right on the hillside between
where they have the golf courses and stuff up in there.
Between like Town Center and Charleston on the 215.
What do you see happening with Vegas over the next 5 years?
Well, it's in an explosive growth trajectory, like it has been during every boom cycle. The difference between Vegas and San Diego is it booms more in the boom and it corrects more in the bust. That's because the economy is really tourism centric. So the first thing people cut when they are having hard times in a recession is their Vegas vacation. The first thing companies cut is their corporate trip to Vegas. It doesn't look good.
Yep.
You spend millions of dollars in Vegas if the economy's down for a public company CEO. So then the casinos lay off workers. They stay open because the casinos are always profitable. And then everybody's laid off, and then there's distress. There's no like one employer in San Diego, one industry that's going to just collapse.
But isn't it more diverse economy now?
It is more diverse now than it was then, but it's still more concentrated than any other city of that size in the country.
Okay.
So I would say
because there's a lot more companies in Vegas now that it is. I understand the casino is a main player, but aren't there there's a lot of other industries?
Absolutely. Yeah, that trend had already happened before 2008. It was already started. The sports teams are getting a lot of press, whether or not they're more of like bringing attention to the positive benefits. They may not be the driver. They're the symptom of the success and of the diversification now that it's a bigger city. And also, the trend away from like worrying about the vice. Like the only reason they weren't there before, why weren't they there in the 80s and 90s, the city that size, is because the vice element and the gambling element. And now that sports gaming is legal everywhere, like what's the difference in Vegas? And these guys are saying, like, well, we got $10 billion for your team. So they all come over. Oakland loses their teams one by one because you can't do anything in California.
Yep.
And when Vegas sees opportunity, they'll approve $4 billion in like 72 hours. No problem.
Yeah, which is wild. So with the, what about Mark Wahlberg? What do you think about it? It was Wahlberg Studios and stuff he's doing out there. Are you familiar with all this?
Yeah, I mean, I've heard that he's doing the studio. I've heard that there's more of a focus on trying to make movies out there now than there used to be. The first one that kind of pushed that was Nicolas Cage. Like he moved out there a long time ago and recruited some other Hollywood people to move out there. He recruited somebody that like got Mark Wahlberg to come check it out.
Gotcha. Yeah, because I noticed that he sold his house in LA, moved out there into Summerlin area, and now he's building some mega mansion plus the studio. He's got like some billion or $3 billion studio out there.
Yep, I read that.
And he's trying to pull a lot of the movie making away from Hollywood and into more tax business free environment.
Exactly. Yeah, that's what they're doing.
Interesting. Okay, I love it. So tell me about kind of your current real estate endeavors here in San Diego. We're both real estate agents and brokers, kind of by trade and background, but with our development and kind of investing side, what are you doing currently, and what kind of clients are you helping? Because I see you doing more kind of commercial style sales, as well as some of the residential, but a lot of commercial style stuff.
So the market I've focused on in San Diego is helping ultra high net worth families and individuals invest in the real estate sector who are not professional real estate investors. Most of them are from tech or casino or some other space.
Yep.
And real estate's not their primary interest or passion, but they know they should have an allocation there.
Yep.
And even though for them it's small, to me it's huge. They might have $200 or $300 million with real estate. As somebody worth $3-4 billion, and that's huge for a broker to be the one selling them all that stuff, doing the transactions.
Big time.
And I also help those people with asset management services and integrate with their family office to be the boots on the ground because they're totally hands off and they don't have like a full real estate team.
Gotcha. Because you're saying they're smaller family offices, or
Yeah, the clients that I have where I do the asset management services, they have very small family offices, and I integrate with basically the attorneys.
So you're working alongside, obviously their accounting side, but you will handle managing the managers locally.
Exactly. Yeah, I'll put the property manager in place and then review statements and go to the property and make sure everything's running
Hasn't burned
smoothly.
down and it's
Not
doing what
burned
it's supposed to
down.
do. The financials are performing correctly.
Yeah,
et
you
cetera,
get
et
the
cetera.
email from the manager. We want to do this, is that. What do you think?
Yep.
And I'm the person that will respond.
Yeah, it's pretty much what I deal with now on the apartment side, right?
Exactly.
For our partnerships and everything we do is I'm
Exactly.
a glorified asset manager managing the managers.
Right.
So,
Yeah, exactly.
and just making sure everything's is hopefully running smoothly. So
Absolutely.
what do you see economically in terms of where we're at with inflation, with where things are headed? Do you see everybody keeps talking and waiting for corrections, right? But we keep running into strong jobs reports, strong this, strong that. But it's like, then you see other data that looks really bad, like credit card debt and debt's going up, right? And costs are going up and the cost of everything's going up. So we were talking about it before this, but there's got to be a pinch point at some point where that thing goes the other way.
So, real estate economy, national economy, it's all cyclical. We both know that. Not everyone realizes that. So it's always been cyclical. How severe the cycles are partially determined by the Fed and the government's response to those cycles and how far it goes before the cycle. But usually the next peak is higher than the last peak. And that's why all of these investments like index funds, apartments, commercial real estate, they're all a good long-term investment. But with respect to what's going to happen next, I think the reason why you hear less about that than before is like, look at, for example, the really big prognosticators. They were saying, okay, now's the time during the COVID thing. Look at it now. And now they've been real quiet. It's because the response from the Fed and the government during COVID is so far outside the norm of any historical trend you could try and link it to. You know, printing 60% of every dollar in circulation over the last 3 years.
Is that? I've heard those statements. Is that true?
Everything
Because our national debt was, 29 trillion prior to COVID, and now
we're not
it's
talking
like
about the debt. We're talking about M2 money supply. Money supply, like when the Fed through quantitative easing,
right,
and through just straight printing the money, they add money.
But isn't maybe educate me here for a minute? If your national debt keeps rising, that means you're spending more than you're bringing in. So that means you have to be printing money to do that, correct?
That's true. And we're printing the money at a much higher rate. It's been exponential over the last 15 years.
Okay.
Then the debt's expanding, both of which are a huge problem.
Correct. So we were $29 trillion in debt prior to COVID. So we had printed a shit ton of money prior to that. Correct?
That's right.
But you're saying now we're at 35 trillion, if I'm not mistaken. I have to look at the numbers.
Right. And the speed of that addition just over 3 or 4 years is
so that's what you're talking
paradigm
about.
shift.
So the velocity of that
increasing.
money into the supply system.
And if you look at the prior, a lot of that comes from 2008. So a lot of this is since the last big crash during the Great Recession, where they probably did forestall what you'd call the reset of the long-term debt cycle, like Dalio talks about. Mm-hmm. And so typically the long-term debt cycle resets every 70 to 100 years.
Yep.
And the Fed's introduction has slowed that down. They see they reacted wrong to the Great Depression, studying the data. And so they aggressively moved during 2008. And then they said, there's no real problem with that. It didn't create a big inflation problem, 08 to 2020. So let's just do 10 times that much for COVID.
Jeez.
And then remember they said,
that's rational.
transitory.
That makes complete sense.
Yeah, there was a lot of economists like Krugman and all these guys saying that's obsolete. And you don't hear them talking about that anymore. You haven't seen Krugman's Twitter post in years.
He's shut up now.
Talking about woke stuff. He just stops talking about his projections because there's serious inflation problem right now. They're really struggling to get under control. And they're not correct in their assessment of when it's going to get under control.
Right.
Like you could see they keep adjusting
Well,
projections. Markets keep adjusting too.
Yeah, they keep pushing it down the line.
The leaders and the markets haven't been on the same page, and they've both been wrong because we're in such uncharted waters that it's anybody's guess what the effect is going to be. So
okay, so let's dive into this a little bit further because I'll give my opinions here too. I believe currency is the next change, right? I mean, we've seen it typically every 50 years on average, 40 to 50 years, a world's reserve currency changes.
that's true.
If you go back to cycles.
And it really, even since we've been the world reserve currency,
which is 1971, right?
So the change off the gold standard was something similar to what's happening now to deal with the debt problem. What's happening now is the government is monetizing the debt, meaning they're making the debt affordable by forcing the dollar to be worth much less.
Correct.
So savers are getting slaughtered.
Screwed.
It's not even close. They're
like there's no point. You feel like there's no point in saving.
You're losing.
Just go get as much good debt as you can and leverage it, right? The correct way, right?
The people that win when the government monetizes the debt is leveraged investors. The way you can leverage conservatively without losing, like the stock market, you get wiped out with a short-term fluctuation.
Right.
So that's a dangerous place to employ leverage. In the real estate market, it's totally standard and safe to employ leverage.
Sure.
You can get 30-year fixed
as
debt
fast. Yeah.
So by doing that, just like you said, the government's decreasing the relative value of the dollar.
Yep.
Everyone's income's going up. Values of the property shoot up because they're valued on the dollar.
Yep.
And so you're a big winner if you have leveraged real estate.
Yeah. Against fixed rate debt. I mean,
Same as what happened, all these old stories like our parents and grandparents' generation. You bought a bunch of real estate in the 70s, 80s. It was not so great for 10 years. And suddenly it like 10x'd in value.
Because of the inflation rate.
Yeah,
and they had fixed rate debt against it.
That was when they came off the gold standard and they started printing money.
Okay. So what do you think is going to happen with currency?
What I think will happen with currency is the Fed will continue to monetize the debt until they go off the what you'd call analog dollar standard to some sort of digital currency.
Okay.
Whether that digital currency transition incorporates any of the existing digital currencies that exist or digital stores of value that exist.
Okay.
I won't even name any of those, or some new thing that the government creates because,
Well, the U.S. created the digital dollar.
They have created it, but they haven't really implemented it yet in a way.
Tell me the difference right now.
I would say that
because China did. Chinese came out with the Chinese digital yuan back during COVID, like in 2020. They literally started it. It's all over Bloomberg and Forbes and everything. And then Jerome Powell came out and did the similar thing with the dollar, but like you said, it hasn't really been implemented. Why do you think they haven't done that yet? Are they trying to figure out how to do it?
I think it's controversial. And so it'll be implemented over time, generationally.
Or when there's chaos.
No, I mean, chaos is a ladder.
Yeah, because I feel like something has to change because I feel like the boat's too far out to sea. They know it. It's filling up with water. They can't turn the boat They can't turn it around and come back to shore. Right? So they just keep printing and doing what they're doing, knowing full well there's going to be a sinking and they're going to have to adjust to a different currency.
The fact that if you stay in the same currency and the tracking stays exactly the same, the monetization of the debt and the downward pressure being put on the bottom 96% that aren't benefiting from the inflated asset values like index funds and real estate tremendously benefiting from the monetization of the debt and inflation. It kind of like makes it less noticeable when you make a switch on them on how you measure everything, right? They've also changed how you measure inflation.
Yeah.
Because if they didn't, it would show 10% inflation. I've used the old standard for housing inflation. And like NAR has talked about that and the Federal Reserve. So
it's hidden.
Yeah, they're not advertising. They're not like putting an ad out like, hey, it's really bad, but it'd actually be a lot worse if we didn't change how you measure it. Elect us again. Like they're not saying that,
Holy cow. So you think they continue to monetize it until some point they switch?
Mm-hmm.
Okay.
I mean, think about what we do for a living. Imagine if you were on a fixed income and you're a tenant.
Yeah, well, we were just chatting about that because we're seeing in different markets right now pressures due to the high cost of housing. Mm-hmm. Not just housing, but living costs. Mm-hmm. Everything's going up. Groceries, gas, right? All these costs are going up. And so tenants that technically are paycheck to paycheck in a way and technically could afford these rents are struggling.
That's
and
true.
We're seeing higher delinquencies, then you're seeing higher evictions, and then you're seeing higher vacancies. And we're seeing across multiple markets, where that's Phoenix, you're starting to see it in Las Vegas, in Texas, in Florida, and some of these kind of up, down Amazon smile states, right? The Sunbelt states. And we're seeing it in our apartments. So we're having to be very tactful right now with cash flows.
So to that point, and a word for the wise to everybody listening, like you and I understand this really well, but those tenants living paycheck to paycheck, they're in tremendous stress and negative effects from what's happening. To prepare for what might happen next, we have to make sure we're not living their paycheck to their paycheck. because when there's a big shift, the only way you get wiped out when you're in a winning hand position is if you can't weather the storm. Like imagine if the government had been even crazier than they were during COVID, and you only had 6 months of reserves on a big apartment portfolio, be in big trouble. So that's why diversification is important and reserves are important, particularly in times of transition.
But at what point, I mean, you can have all the reserves you want, but it's like, holy cow, if you're like peeing into the wind because you run into something pretty drastic. I mean, how do you, I mean, even if you have low leverage debt, like on one of our properties, we have 62% loan to value, right? But because of some vacancy issues and other things, it even continues to struggle. So,
I would address that the way Warren Buffett does. He says, I will be the last man standing. We don't rely on the charity of strangers or the good grace of the government.
Say that again.
I said, Warren Buffett says, Berkshire is going to be the ship that won't sink. They do not rely on the charity of others. They don't need it. In fact, they'll capitalize on those opportunities when others need help.
Fair enough. I agree with that because it is weathering the storm.
So obviously you're weighing growth opportunities with, risking what you need to get what you want.
Yeah, but does it hinder off you taking because I think there's amazing blood, I call it, in the streets at the moment, especially in the multifamily space, because you're seeing these syndicators, right, that bought a lot of these deals during the 2020, 2021, 2022. Rates went up. They're in variable rate debt. They can't get out of it. They can't refi, right? So now they're either stuff's getting modified, maybe going back to banks, number two, or selling at drastic discounts, and at least the equity guys are getting wiped out, but the loan's getting paid off. And that's happening right now.
It's certainly happening right now, and there's definitely opportunity there. However, if you look at blood in the streets, like when the Rothschilds want to buy, when Buffett wants to buy, right? Like that's Baron Rothschild's quote. I buy when there's blood in the streets. That's not now.
Right.
Now is like, oh, I sprained my wrist. I can't lift today. Maybe someone else will take your personal trainer appointment. Not like Vegas, like you're on life support and somebody's signing the documents on your behalf. You don't even know what's happening. You're in the hospital. That was 2008 in Vegas. We walked through apartments that were selling for like $18,000 a door in Vegas. Like, I don't know about this one. The air conditioner's messed up. And who took advantage of that? I was selling those to the founder of Monster Energy drinks, and houses that were like $40,000 a door. And he was able to just go get a margin line or pay cash based on his liquid portfolio because he was able to take advantage of that. Yeah.
So let's talk about that. How do you take advantage of the current scenario? Of course, having massive cash, but let's presume you don't have a lot of cash. You have some, and then you want to go take advantage of it. Is it linking up with other folks?
Of course, yeah. What I do is I take my own capital and invest it in zero risk of loss, low leverage, value add apartment deals and vacation rentals in supply constrained markets with long-term good rent trends with positive leverage. And that's it, nothing else. Okay. And if I can't do a deal like that, I just keep making active money and buying index funds. And if I find a deal that is really great that I wish I could do, but I didn't have the money to do it, then I'll go get an investor and syndicate it one-off. So I'm not pursuing full-time syndication like you are. I only buy the deals that are just a complete no-brainer, silly, off-market, under-market. Why is because, and I've been wrong, so it shows that you were right. But because we talked about this, you and I had lunch at the patio in 2016 before the proprietor went to prison, and we were sitting there talking about. Do you remember that?
Dude, I love how you just dropped that in there like that.
Yeah, of course.
Yeah, Mr. Gina, Miss Gina Champion.
Yeah, she's in the clink. So anyhow, so we had lunch there, and
was that 2016,
2017, 2016? We're talking about you were going real focused on the syndication.
Yeah,
doing
that's
brokerage.
when we started pretty heavy. Yeah,
brokerage still, but you had done some deals, but you were really going to focus on it.
Yeah,
and you were starting to raise capital more seriously. And I was like, I want to do that too, but here's the problem, Justin. I'm kind of the same as I'm saying now because I thought things were much the same. I want to start doing that with my relationships when it's 2008, when it's the S&L crash in the 70s or 80s, RTC
Meaning
days.
You have your relationships now and you would actually approach them when there's blood.
Right, because I don't want to risk a relationship that is a very close personal friend. an extremely valuable brokerage client
Yeah.
on a probably win. Because
Gotcha.
if it goes poorly, I could put the brokerage relationship
And
at
your
risk
personal relationship.
and my personal friendship.
Yeah.
And if you're doing it in '08, you're going to win.
Yeah.
If you're doing it in RTC, you're going to win. If you're doing the Great Depression, you're going to win.
Yeah.
And they will have money then. And so those relationships can't be risked
Gotcha.
on a probably good opportunity. It has to be, a zero risk, no brainer, like those Vegas deals that you could buy
Sure.
for $20,000 a door
Yeah.
in a Class B neighborhood that
Yeah.
are now trading for like $350.
Yeah. That's wild. How far do you think we're away from some crazy stuff happening?
I don't know, because I'm not nearly as smart as all the people who are predicting and they're wrong.
Yeah.
Like Ray Dalio is a really smart one to follow. And he was
He
like,
continues to be off, right?
yeah, right. He's off on the dates, but if you read what he said, like we're going to have the Great Depression, blah, 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 in 2020, when the COVID lockdowns happen, he's like, don't lock everything down, or you better do something major. The stuff he's saying maybe they could do to protect us and not have this big Great Depression crash, or the caveats in his prediction were like short of just something complete paradigm shift from anything that's ever happened before. They did 10x what he would ever imagine. He's like, we're gonna need something like 2008. Like, here's 10x 2008. Don't worry about that.
Oh my God.
He's like, I didn't anticipate that maybe the government for the first time in US history, going back to 1776, would just in 1 year print 40% of the dollars in existence now. And then over the next year, another 20% after the problem was solved. Like this latest thing that Biden got passed was after we knew we were safe from COVID and people were back at work, and he wanted a big boom because they didn't see inflation. So he's like, why wouldn't I, going into an election year in a couple of years? Sure. I mean, I bet he would love to go back in time or get really upset with those economists that told him it wasn't a problem, but they didn't know. It's never been done before. It didn't happen that right away.
Holy cow.
So I don't know. I mean, who's to say? But whether it's next year or whether it's 10 years from now, that's when I want to start syndicating big deals.
What's kind of your current portfolio now in San Diego?
I own apartments in PB myself personally, and oceanfront vacation rentals. They're all 30-year fixed debt under the going in cap rates.
Did you? What is the vacation rental? There's like a few hundred permits I think still left in San Diego, but how does that?
There's 900 or 800 something. I haven't looked in a couple of months because those permits are available outside of Mission Beach. So
because Mission Beach is unique, right? You don't have that caveat. It was kind of set.
They got
Tier 4?
carved out of the permits, and they had their own Tier 4.
Okay.
Mission Beach was like 40-something% vacation rentals before the ordinance.
Right.
I think it's gone down to 38% or 35%.
Okay.
And those people on the wait list, I was one of them on my second unit, that my mom was on the wait list for a permit for that unit. And now she came up for her place in line. And so now, for my mom's lifetime, I have that permit.
Gotcha. So with Mission Beach, they've given out all the ones they're going to give out, and then you just have to get on a wait list now?
There's no way to get on the wait list now. It's closed because of the pending litigation. This is me prognosticating. The city hasn't confirmed this, but the attorney who, my family's attorney that was referred to the Short-Term Rental Alliance, same one that did the mini dorm case for Brennan and all of his buddies. I referred him over to those guys. They knew him too.
Yep.
And Steve McKinley thinks that the reason why is because it would reopen the statute of limitations if you put people back on the wait list. Because then you personally, if you got on the wait list today, could say, hey, I turned in an application, you waitlisted me, now I want to sue. So they're not going to allow any more wait.
Until they figure out the lawsuit issue.
And it'll be settled or will win or lose way before the 100 and something people on the wait list come up for their place. But it'll be a big group of people all trying to come in at the same time when it does get down to zero.
Gotcha. Interesting.
Meanwhile, if you want to buy, 4 vacation rentals in La Jolla, 250 vacation rentals in La Jolla, you can do that because there's like 800 or 900 permits available.
But you can't. So any vacation rental you buy in Mission Beach has to have the permit on it. Is it transferable?
Yeah, you can't. No, it's not transferable. There's a loophole. The loophole is really simple, and it was intentional. Like,
through an LLC or something? No,
not even that. You don't even need LLC. The LLC is the way to do it most cleanly. But say like my vacation rental where my mom is the tenant who has the Tier 4 permit.
Okay.
If I sell the property to you, my mom's lease remains in place. Her host status remains in place. If she wanted to keep doing that, you'd have to evict her.
Gotcha.
If you wanted to keep doing it yourself, you guys could have some sort of agreement during escrow whereby she continues to be your host. You have to trust my mom. It's obviously,
Sure.
you might not want to do that. Most people probably wouldn't, but that host could stay on if they're a tenant.
So properties that are being sold that have the permits on them now in Mission Beach, those go bye-bye if they're selling it to just homeowners.
As long as the tenant host doesn't stay in place.
Gotcha.
So like if you're the owner host,
Yep.
you check the owner box on the city's website that you're the owner host.
When you sell it, that goes bye-bye.
It would, yeah, unless you did something where
Unless you were a tenant
you
host.
transferred the property to a trust or LLC and then signed the lease. It's still you, and the city could probably challenge that and say you switched from an owner to a tenant, just purposely trying to circumvent. Now, if legitimately you had the property in LLC to begin with,
Yeah.
then you would be the tenant legally. That would legally transfer, and they know it, and they've talked about it. That's a loophole they want to close. If the anti-vacation rental people don't want to see that closed, and the pro-vacation rental people are like, that's what they talked about. We sat at all these meetings,
Yep.
and they said they want tenants to benefit from the legislation. And they told the city attorney, well, don't let people be a tenant on their own property. And the city attorney's like, you have to. You can't say some tenants. That's how
Yeah,
you
correct.
lost the ordinance at SDSU by saying 7 people who live there if they're not in college,
Right.
but not if they're in college. That's how they lost the RHOP permit. You
Interesting.
can't pick and discriminate on types of
Yeah,
tenants.
of course not. Because then you're opening up
Fair housing.
more lawsuits. Yeah, for sure. Huh. So then how are properties trading right now that have, you're saying they're just slowly going down?
Doesn't that show the point that we overestimated the importance? Because they're not going for much less money. They're going for about the same money. That difference, it's a little bit less than the high comps pre-ordinance. Because by the way, the highest comps in Mission Beach are after the ordinance. They actually match up to rates. So the highest comps are in 2021 too. And so prices are down slightly in 2024, but they're up after the ordinance passed. And those are going to second home buyers.
Okay.
And people that are like, you can still get a tier 2 permit and rent the property 90 days a year. So you
Okay.
could live there in the off season and summer rent it.
Yep.
Or you could rent it to college students and make one of them get a tier 2 permit as long as they live there the 275.
So there's plenty of tier 2s.
Tier 2s are unlimited.
Okay.
Any tenant or owner who lives in the property 270 to 290 days a year, I forget the exact number, can rent the property out 90 days a year under a tier 2.
Gotcha.
Or if it's a duplex, they can rent the other unit out tier 2.
Okay.
Or if it's a 10 unit, if you had 9 roommates living in the unit, each one of them can get a tier 2 permit for one of the other units.
Okay.
That's another thing they didn't think would be used as much as it's being used. And they would like to change the ordinance probably one day to make that not possible.
Huh. I think you figured that whole ordinance thing out.
Only for the last 3 years I've been paying about.
But it's mainly because I'm sure you have, like you said, if you're managing high net worth clients and families and things you're doing there, having that knowledge and expertise in that area is critical.
Oh yeah, I'm like the vice chair of the planning board there. I'm on the town council. I'm at every single city meeting. I've been at all the lobbyist meetings. I'm on the board of STRA. I dropped out of that to go down to the board advisory role.
So will the vacation rental slowly decline, like you say, over the next few years too? Because as things transfer and sell and transfer and sell?
I think in Mission Beach, they won't decline because of the wait list.
Okay.
They declined in the beginning, meaning the full-time
So the people that are on the wait list can still get them as they come up.
Right. So like if a property sells, the license doesn't transfer,
Yep.
then somebody on the wait list is going to take that tier 4 permit.
Gotcha.
So in order for the number to decline
You'd have to eat through all that wait list.
and then not reopen it.
Yeah.
They're going to allow those permits. Remember, they actually needed the 4,000 something they wanted,
Yep.
and they don't have them. They have these people on the wait list. That means the program's not fully funded. All those people should be paying $1,000 a year plus 20 grand or 50 grand a year in TOT tax.
To be on the wait list.
No, to fund
Oh,
the program.
to fund-
I'm talking
okay,
about tier
gotcha.
3.
Yeah.
They expected that to be more than fully taken on the lottery and then
Gotcha.
have a wait list there. And they were just wrong.
Okay.
There were not 3,000 something vacation rentals outside of Mission Beach. There just weren't. There was anecdotal because if you live in the shores or in Bird Rock, or you had 2 vacation rentals in your street on Mount Soledad, you're like, this is a disaster. But in general, there's not a lot of vacation rentals in La Jolla. It doesn't pencil.
Yeah, because the high price you're paying, and then no matter what kind of rent you're getting.
No, it does not pencil.
just
The
doesn't
reason people buy those properties is for appreciation and long-term hold. It's a really good store of asset for ultra high net worth people.
Yep.
And vacation rentals, just because you don't want a long-term rent, it's a little bit less. But either way, it's a terrible cap rate. You wouldn't buy that property for income. You're buying that property for appreciation.
Yes.
So only ultra high net worth people are making those investments.
Yeah.
It makes a lot of sense for them because you want the value to be in terms of appreciation, capital gain,
Yep.
if you're a high taxpayer.
Yeah.
So that's why those are the realm of the ultra high net worth investors.
Tell me your knowledge of tax code. This will be actually helpful for folks.
What do you want to know? I'm a hobbyist there.
Oh, you are?
No, I love it. Yeah, I didn't know anything about taxes.
I'm learning something more new about you. I didn't know. So you understand the tax code pretty well.
Yeah, I'll tell you why. I didn't know anything about the tax code from the way my dad brought me up in the business and taught me, because he's like throwing all this stuff at the accountant. He does it. And then it didn't really seem like it mattered at that point. And I was wrong, because the reason I thought it mattered, I didn't understand there was a way to save taxes yet. Yeah. I was in my 20s. But around the Great Recession, I go to buy a property in 2008. They're like, you don't qualify. And I'm like, how do I not qualify? I make hundreds of thousands of dollars a year. I have very low debt. And they're like, your DTI doesn't work. And I was like, what's a DTI? And why did I not know what that is?
Yeah, they're like, we looked at your tax returns and
like,
you don't make any money.
They're like, you're poor. And I'm like, what are you talking about? I don't understand what you mean. Like, and so I had to learn what a DTI was in 2008, because pre-2008, all of my loans and my clients' loans were stated income verified asset.
Correct.
I wasn't doing the ninja loans.
Right.
I was like, okay, you have over $1 million liquid at Wells Fargo.
Yep.
They'll give you the best rate possible, minus 0.5% in the private bank.
Yep.
Stated. They tell you what you make, you sign it.
Right.
No problem. And they use that like, oh, okay, Justin, you're a real estate broker. Our range for a real estate broker is like 90,000 to $1 million.
Yep.
And you have 2 or 3 million in the bank. So based on that and the fact that your net worth statement is over here, it's reasonable that you make 700 grand. So let's go with that.
Yeah.
That's how they used to do it.
Well, and that's somewhat fair.
Yeah, it wasn't off the
if you have
tax
that kind of
return.
cash in the bank.
Exactly. Yeah. And so after the crash, there were some laws passed that said they can't do that. They have to only go off the tax return, or they can be criminally liable. So that's why like First Republic could still do it, because they were floating that risk to have their whole business, but they were very careful. Their loans were really safe. But if they were wrong and you sued them, the government came after them. They were criminally liable it was like the Dodd-Frank Act.
Yeah.
So that's why only First Republic Bank was doing that after the Great Recession.
Interesting. Are they the only ones still doing that, or they're not doing it anymore?
I'm looking. I haven't found anybody else.
Okay. Interesting. So, because I was looking at this, I was trying to ask my accountant the other day about this. What's the alternative minimum tax?
Oh, the alternative minimum tax is like...
Because I just got screwed on that this last year, and I didn't understand how I even got into that category.
Everyone has to compute.
Well, they compute it both ways, right? And then whichever one is higher, they go after that one or something like that?
That's right.
Okay.
Yeah,
but how does that become higher? I guess is maybe my question.
If you have lots of paper losses, it becomes active.
Which would make sense.
Meaning, if you're using bonus depreciation like you and I do, probably, and using that bonus depreciation to offset active income, if you have rep status.
Is that recent that they...
No, minimum tax has been around for a long time.
But then how do, like, say, a Trump or Cardone or all these other guys use, because that's what we use, bonus depreciation to write off a lot of this income. And up until recently, I haven't had to pay a lot of income tax because of those write-offs. So how does that all of a sudden kick in?
I'm not an expert in the alternative minimum tax because there's nothing you can do about that.
Okay.
There's no strategy better than what you're doing now or what I'm doing now using the bonus depreciation. So I let the CPAs understand how to calculate the alternative minimum tax. What I've asked them is there a different structure? Like, we're using bonus depreciation, we use this, we use that, legally to comply with the tax code to minimize your tax liability. Is there something further we should be doing to no, that's not possible. They remove all those paper losses in their computation of it. And Trump and Cardone, those guys are paying the alternative minimum tax just like you and just like I get hit with sometimes, or everyone would pay zero. That's a big real estate investor. And that's why they created the alternative minimum tax.
When did that come into effect?
Oh, like during the time period right after they changed the tax code to not allow everyone to do what real estate professionals can do now. I think it was the 80s or 90s when they took away the depreciation. They created a $10,000 cap on depreciation per year for like a doctor or a lawyer. Like, oh, it's going to kill the real estate market. Well, the one thing they did is we need real estate professional status because somebody who's actually a real estate developer wouldn't be able to do business. It would kill the economy if you couldn't write off the legitimate money you invest in putting into the property, remodeling it, capitalizing it. So they created rep status. Then they saw, well, the reps people are not paying anything, after that. So then they introduced the alternative minimum tax, not just them, but also for Wall Street titans, and people are using carried interest to pay zero in hedge funds.
Gotcha. So because they want people to pay something.
I mean, it's still like a fraction of what a doctor or a lawyer would pay if they're making what we make or what you make or what I make,
Gotcha.
Think about like just a real estate broker that makes $100,000 a year. They can pay nothing by buying a property every couple of years until bonus depreciation fades out. So without alternative minimum tax, people would pay zero. That wouldn't be fair.
You're saying the brokers would pay zero?
Yeah, if they're real estate investors on top of brokers.
You just wipe it all out.
Isn't it incredible how few know that?
That the alternative minimum tax?
No, just about bonus depreciation or tax.
Yeah, I have to teach people about it all the time.
Like I'm in Reba, I go pretty regularly, and I've made friends with a lot of the people there, and people that do tremendous business, way more than me. I've been blessed to have a pretty good business.
But they're not buying properties, so they're not getting the bonus depreciation. But they would still have the alternative minimum tax. It would just be much less than their traditional.
Right, but they could be paying a tenth of what they pay now. Gotcha. You could go from an effective 50% tax rate to 10%.
Right. Okay. Makes sense. I love it. Yeah, because I had to learn more about that because my alternative minimum was much higher in 2023. Yeah, three than normal. So I was like, wait a minute, I'm writing off a lot of paper losses. What's going on?
Exactly.
Interesting.
And introducing this to these high net worth investors is a way to get them interested in vacation rentals, because you know about the short-term vacation rental loophole?
No.
The short-term vacation rental loophole says in the IRS tax code that the vacation rental you manage yourself is treated like active business. Like if you owned a hotel, you're not limited.
So now you're a real estate professional.
No, that business is active. That taxpayer is a doctor. But because they invested in a vacation rental they manage themselves, that income is considered active as well. And can wash the doctor income. It goes in the same pot, like our commission income.
Versus cap gains in ordinary.
Exactly. Like our commission income and our real estate income net out, either on Schedule E from the dividend or on the front page of the return, right? Theirs doesn't. They get limited. But if it's a vacation rental, they don't get limited. And they can take bonus depreciation.
You're saying because our investment income's capital gains, and you're saying that the brokerage commissions is active.
Well, some of our investment income's capital gains, but all of the real estate activities, whether it's sale, depreciation, K1 from an LLC, all of that income is going to be netted out with our commission income. We're not capped on those losses. So if you had $10 million in depreciation losses, they're fully legitimate. You go buy a $50 million property.
And you're saying to wipe out commissions.
Yeah, you could have an $8 million loss carry forward. If you made $500,000, you have a $10 million, right? So a doctor can't do that. They would only get 10 grand. And then they can only actualize those losses when they sell the property.
Unless they were classified as a real estate professional.
That's correct. But the only way a doctor can be classified as a real estate professional is if they file jointly with a spouse who's a real estate professional, and they audit the heck out of those. You can't cheat.
Even if they're spending a certain amount of time?
No, because you can't make more money in anything else other than the real estate business. And you can't have a full-time W-2 in another business where you spend more than X hours. Like if you read all the requirements there, we don't need to read them because they don't apply. It's just, we don't do those things. Yeah. So we're really in real estate. We're not like trying to like become that.
Yeah. But I have a lot of attorneys, doctors, people that are high net worth individuals that want to minimize their taxable events. So of course they'll go invest in syndications and stuff to get these negative K1s to pass through and get the benefit from it. But you're saying it can only offset capital gains and not necessarily the active income from a doctor.
That's right.
Okay.
Unless they have their wife become a real estate agent and really, truly be an audit-proof full-time real estate professional, then they can file jointly and do it.
So they need to go link up with someone who's a real estate agent.
Yeah, their wife or husband. If the woman's a doctor,
but they have to be spouse.
Exactly.
So you can't be boyfriend girlfriend.
Exactly.
I'm trying to find loopholes here, Rob.
Yeah. So there's that other risk. So yeah, the loophole is the short-term vacation rental loophole or a hotel.
Because that'd be considered active income.
Yeah, because you're actively managing it. It has to be less than a 7-night average stay because it's a hotel. The IRS says it's the same as a hotel. You're checking in and out guests, dealing with calls every day. That's different than what they'll consider passive activity, like
an apartment
tenant.
building.
You're just taking care of the repairs. You're at the property like 5 or 6 times a week, maybe more on a vacation rental. Gotcha. So it's an active business. That's why they consider that. You can't have it professionally managed and benefit there.
Right. You have to self-manage. Okay. Huh. See, we got all educated in the tax code today. I've loved it, but I'm sure everybody, I don't know if people that aren't technical and don't love this stuff, they'd probably be like, what the heck's going on over there?
I know, back to the Vegas mob stories. That's more fun.
So finish us off. We're coming up on an hour, but tell me something or things that people may not know about Vegas.
What do people not know about Vegas? If you go to Summerlin or Green Valley and you don't look towards the strip because it's kind of flat, the valley, so you kind of see the strip.
Well, that's the one thing about Vegas. Like you can literally see the entire city.
Yeah, you can see the whole thing. Yeah. Very easy to learn to drive. It's a square grid, because the whole city was built in the 80s forward. It's not these old cities that was pre-road. And, you can use the strip to know whether you're east or west.
Yeah. basically.
And if you know where the hotels are in the north end and south end, you can orient yourself in 2 seconds. In San Diego, you can't always see the ocean.
Right. And San Diego's more rolly hills, and it's kind of, segmented in terms of the neighborhoods and stuff. So yeah, it's not a flat zone.
But where I was going with that is if you're in Summerlin, it's the same as being in Scottsdale effectively. Like you don't know that you're in Vegas until you see the slot machines at the local bar or at the grocery store. But other than that, it's just suburbia.
Yeah.
And so people just think of the Strip and they don't realize that Vegas is a real community with like families and businesses.
And most people who live in Vegas, don't go to the Strip.
Exactly.
Right? I mean, all my friends that live there and stuff, and I go there and we all go, hey, we're going to the Bellagio. They're like, oh man, but that's no different than San Diego. If someone says, oh, I'm coming to San Diego for tourism and I'm going to SeaWorld, we're like, oh, man.
SeaWorld, the zoo. You're like, I've been there 74 times.
Right. Downtown, et cetera. So anything else about Vegas we need to learn today?
There's no state income tax.
Yep.
And unlike most states that have no state income tax, no estate tax, there's also very low property taxes. And that's because the casinos pay for everything that...
Similar to Phoenix.
Phoenix has...
low property taxes too.
That's right. Phoenix is not zero state income tax.
Yeah, it is.
No, it's not.
It's not?
It is not. It's very low. It's like 4 or 5%.
Oh, I thought it was
Arizona
0.
is not. And a lot of people say that it is.
I thought it was.
It kicks in at a higher level at like 80 to 90,000, but it's there.
Okay.
Like if you make 100,000 a year, you're paying state income tax.
Gotcha.
It might be like $4,000.
But Vegas is the only one that's not.
No,
so low property taxes and no state income tax.
There's 7 states that have zero state income tax. Texas.
Are you spending time back and forth a decent amount?
No, not much. I mean,
so you're enjoying paying the California taxes
with bonus depreciation. So like in years that, we don't pay any federal income tax because of buying a property and bonus depreciating it, we're still paying California.
Correct.
Because California doesn't conform. The first time that I had that explained to me in like 20...
So the feds conform to it, but the state does not.
Right. But you still save money because they give you the shorter depreciation schedule.
Gotcha.
The same as like Trump and Kushner used that shorter schedule before Trump's Tax Cut Jobs Act that gave us bonus depreciation 2017.
Yep.
But like in 1999 or in 2015, they still had bonus depreciation. It just, you couldn't take it all in the first year. You get a 5-year schedule, 7, 15, and your normal 27.5 or the commercial schedule, 30.
Gotcha. But, so if you got a big K1 from a bonus depreciation event on an apartment complex, which is typically you get it that year, you would have to schedule that over 5 year or
parts of it. Yeah. Parts.
Interesting. Yeah. I need to learn more. I need to dig into the taxes more because I feel, and maybe I'm just wrong. We pay these tax professionals to be the savvy ones, but I keep finding errors.
It's not just errors which happen, but it's also like I highly recommend them. They're incredibly good. And I have a lot of ultra high net worth clients that use them, but my CPAs didn't tell me in 2019, do bonus depreciation. You have a big year. I asked them about it in 2017 and they're like, oh, you don't really need it. It's not necessary, blah, blah. That's because they learned that pre-2017 Tax Cut Job Act, back when a cost seg study cost $20,000. Now they're like $4 or $5 grand.
Yeah.
And also
to do the cost seg,
no bonus depreciation. So unless you're making millions of dollars a year, it probably doesn't make sense. And also they don't think of the strategy like you're never going to sell. They also have in the back of their mind the terribly high recapture. We're not selling these properties. We're either going to exchange or die with them.
Yep. Interesting.
So we're never going to have the recapture.
Okay. Or it'll make you years down the line, right?
Yeah, if you want to sell. But selling, you know what they say? What did Harry Helmsley say? Real estate's for buying, not for selling.
Unless you have to.
Unless you have to. Yeah. So the idea is make sure you don't have to.
But then how do you move capital? Just do refinance, cash out refis?
Right, exactly. Like think about a property that you bought for 70 grand in La Jolla back in the 70s. Like the one I've got in escrow right now for 17 million. I think they paid like 80,000 for it or something in the 70s or 60s.
Oh my God.
That was a lot of money.
So the ones that you're selling at over the 10 million mark, is that just high net worth individuals that are some of your other clients? I mean, where are a lot of these clients coming from? They're
like casino, tech, and just ultra high net worth families from my network who want to invest in a really good store of value with a strong income stream and benefit.
And they can basically plant money and preserve wealth.
These properties appreciate great.
Yeah.
And they're very easy to manage as a vacation rental or long-term rental. And there's always going to be a market for those super high-end properties.
Yeah.
They're incredibly limited supply, like the most supply constrained possible.
Really?
Oceanfront property is the most supply constrained type of property in San Diego. So like how many beach houses are there in Del Mar? That's why they're selling for like 50 million now.
Right.
You know, my dad had oceanfront Del Mar house in escrow for $995 in
995,000.
81. Instead, he bought our place in Rancho Santa Fe.
Oh God.
That's worth today like 5. The Del Mar's worth 37.
Yeah. Yeah. I mean, you had what's his name, Mr. Microsoft.
Yeah.
Why am I blanking on his name?
Bill Gates.
Bill Gates, duh. Buys a $40 million house on Del Mar.
Mm-hmm. Yeah, 43 million. And now there's another one that's real big. The old, it's Ron Fletcher's uncle's house that sold to another ultra, and that's a teardown. They paid more than Bill Gates, but Bill Gates bought it 15 years ago. So today, Bill Gates' house worth more. But these guys paid a little bit more than his, like 48 million. Yeah. And it was a scraper. They're going to scrape it and build. He bought beautiful, the Jacobs home. And
he's remodeling it, but still. But
it was most top of the line possible when he bought it. And they're buying a teardown, like a 70 scraper for the land to build something like Gates' house on.
Wow. This is wild.
48 million for a scraper.
Well, man, I really appreciate it. It's been a lot of fun. I got educated for sure. Where can people find you? Tell me, like, what do you like? Instagram? Do you like Facebook? Do you like email?
I like it all. I'm Rob Brown on Facebook. I am on LinkedIn. Rob Brown Real Estate on LinkedIn. I'm on Instagram. Rob Brown Vegas.
I mean, hands down, in terms of sophistication of kind of the coastal markets and what's going on, in all aspects, not just the residential, but it's just the commercial side of it. Do you read a lot?
I read a lot. I mean, I owned commercial properties. I managed our shopping centers, office buildings for 10 years. Yep. So I've done it and read all about it.
Yeah. Awesome. If everybody wants to find Rob, you have his info, and appreciate everybody listening to the podcast. Signing off.
Thank you guys.